Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site is Dearborn and Max Cabasso, managing directors on the Nasdaq Market Intelligence Desk. We have Steve Sosnick, chief strategist at Interactive Brokers, and Rich Lee, head of program trading and execution strategy at Baird. We're here to discuss approaching a market that's at multi-year highs and how to think about managing risk versus getting exposure to get that return. It is great to have everyone with us. Welcome to Trade Talks, and fresh blood here on the desk. Rich, thanks so much for joining us. And really, that's the question that we've been asking ourselves for, basically since the beginning of the year. You have the market sitting at all-time highs. Investors are determining whether we're managing risk or do we want exposure to those returns. How are you approaching that? What are some of the areas where you do see opportunity?
Sure, absolutely. Thanks for having me, Jill. So obviously, markets at multi-year highs, as you mentioned, right? And stock indices are, at their all-time record highs, but there's also obviously a lot of headline risk out there. There's the risk of inflation that's still kind of looming out there. And I think it's that old sort of adage between fear and greed, right? So people maybe are starting to have a little bit of fear, but are still greedy, right? So how do you kind of continue to get exposure to this marketplace while sort of maybe hedging your bets a little bit? So people are looking at ETFs like RSP, which is the equal weight S&P 500 ETF, right? And so what that allows you to do is still give you exposure to the massive returns that the S&P 500 has had, but maybe takes away some of the edge for that lack of diversification that people are seeing, or the concentration risk that you're seeing right in the Mag 7 stocks, which have sort of in excess of 37% weight in the S&P 500, right? So that's the first thing. The second thing, second product or that asset class that people are looking at are maybe some of the buffer ETFs out there, right? So maybe like the First Trust Buffer ETF, OCTM, or AGAM, which is the Innovator Buffer ETF. And what that allows investors to do is capture some upside exposure, right, but limits it by giving them some downside protection. And those are like two of the themes that we're seeing play out with regards to giving investors exposure to some of the upside, but maybe kind of preparing themselves for some headline risk or some downturns in the economy.
Steve, it's interesting because when I look at the Interactive Brokers 25 most active symbol list, which you can discern a lot from there, a number of the small cap AI related names were in favor over in this week's list. And it's not surprising because, as Rich had mentioned, what do we do with these mega seven names that we've been trading? They're looking for ideas in other areas related to the AI trade.
They're looking for ideas. This week we saw a lot of activity in smaller AI names. The prior weeks we saw a lot of activity in smaller quantum computing names. Those have sort of faded back a little bit, as I think DeepSeek took the mindset back toward AI and away from quantum computing, where it was, let's say, for what would you call it, guys? 2 months?
The end of the quarter.
Quarter, basically.
Yeah.
And so there, differently than what Rich is saying, our customers, because they do tend to be trading oriented, and again, if you're looking at a list of what our most active stocks are, that's going to be dominated by our most active customers. Right. They are assuming risk. They're buying dips, and more or less, the bigger the dip, the more they want to buy it, which works out well in some cases. On other cases, let's say they've been buying Tesla the whole way down. So some cases there's faith, other times it's more of a trading thing. There's nothing wrong with buying dips, and as we see today, that mantra's kind of held because you had a CPI number that by all means should have really shaken the market, and yet here we are sitting here. NDX is up because they bought the tech stocks on the dip, and those stocks, to Rich's point, were able to drag S&P. We're not quite unchanged yet, but more or less back off its low levels, despite more stocks being down than up.
Yeah, which is interesting. And Max, I think that's the activity we're going to see for quite some time until we get more clarity. Even when you hear what's going on in the news and so forth, it seems as if people are afraid to make an opinion one way or the other.
Yeah, we're just kind of, it seems to be status quo. It's been working and it's going to continue to work until it doesn't. And every single time, at least recently, like we talked about, I think it was last week, we haven't really had any of these big prolonged corrections. Any correction we've had has been bought quickly, and it's been very short-lived. We had the tariffs on Mexico and Canada a few weeks ago. By noon, the tariffs were delayed, and it was the market was back rallying again. We haven't had anything really prolonged in a year, 2 years.
It's almost like buying the dip. It's almost like a prop bet.
Yeah, it's just
like who's first.
Are we gonna? It's gonna come back. We're not gonna keep this going, and everybody's on the same side. It seems like nobody has the conviction to really go in on that and say, no, this is the time we're going to go lower. You hear people speaking about it, but there's never really any conviction. And then you get the retail hordes that are there ready to buy it, leading the markets higher, and then institutions are obviously there as well. So it's until something really cracks, it feels like, where we have it's not just a 2-day thing. If we start moving lower, 3, 4, 5, you get a whole week of it. Maybe the second week, okay, maybe we're not bouncing back so much. Maybe that psyche of buy the dip starts to change. But until we get that, investors have no real reason to not buy the dip because it's worked every single time for the past few years.
But are they investors or are they really day traders? To Steve's
traders,
point, I
investors,
think a
same
lot
thing.
of it's right. I think to Steve's point before, when you look at the top list, the majority of those stocks are day trading, and they're darlings. You know, low float, relatively low price, really not a large institutional base, possibly even a higher short interest. So day traders can push those equities around a little bit, and it's also a flavor name at the moment, like AI. Right, you go back, it's
Trends are
blockchain.
what, they're a week maybe?
Right.
Well, those are for the smaller names. But
Yeah.
the number one
big
one
boys
and
are the
two
big
stocks
boys, yeah.
perpetually are Nvidia and Tesla. You can
The
flip 'em
liquidity-
around.
the liquidity is
And,
there.
You know, Rigetti had been number 3 for a while to the quantum computing point. This week it was Palantir, which is very solid number 3. AMD was number 4.
Right.
You know, because the list that Jill is talking about is sort of a 1 week moving average, where you had big earnings last week. So some of the absolute biggest names on the list were Microsoft, were Alphabet. Tesla was the most bought name. Second was when you add the two classes of Google together, both of which had their hiccups on earnings. So, but you know, to your point, Max, it's tough now because so many individual investors, you know, I guess ultimately, you know, Rich is talking about individual investors and their flows into ETFs, passive ETFs. We see the trading dominated by individual investors. The market has a different character to it. The institutions, in many ways, are turning around battleships, and the individuals are very wedded to this strategy that, as you mentioned, it's been working for them, so they're not going to stop.
Right, and most likely the institutions are going to just leave the market, Rich. I mean, they're still. I think because of, you know, to Chris's point, whether it's lower volume names or less liquidity in a name, those moves are certainly going to be outsized. Why, you know, you could see more stocks down than up, but it does feel like
Sure.
you know, things are moving today.
You know, it's interesting, right? Because we talk about sort of day traders, you talk about investors, you talk about, but at the end of the day, everybody's an investor, right? So it's just a question of what your horizon is, right? And so we're starting to see these themes play out in some of your names, which are maybe geared towards investors that have a shorter term horizon, vis-a-vis maybe some institutional investors which have a longer term horizon, and they're playing those themes out in different ways, right? And to Max's point, it was interesting to see with the DeepSeek thing come out, NVIDIA just get sort of smoked, and then look where it's trading, right? So to your point, that trade works until it doesn't, right?
I mean, we're talking before we got on camera, we're talking about the ETFs, and you mentioned a few before. Where would you see investors who are more longer term, who don't want to be in the market every day, putting their money to work at to kind of capture some of this?
Sure, great question. So I think, you know, in terms of investing trends, just like we talked about risk and returns, I think about innovation and legislation, right? So innovation obviously speaks to AI and technology, which is still kind of dominating the conversation. Along those stocks, you probably look at like a ETF like Block, BLOK, or BOTS, right? Innovative ETFs. And then on the legislation front, obviously, with the acting SEC chair talking about a framework for a stable coin, right? You know, we got to start thinking about the crypto ETF, so IBIT and FBTC are probably where I'd start to look for you know, ETF exposure to these themes.
Yeah, Steve?
One thing about the ETFs, Chris, to your question, is we see VOO and SPY and QQQ and TQQQ all are perpetual names on the list. VOO is almost always accumulated because that's the lower cost alternative, but SPY is the one that trades.
Right.
And QQQ has its flows in and out, and depending on the tone of the market, TQQQ can often trade at our shop much more aggressively than QQQ. SQQQ has its days as well, and so it tells you that, you know, and our customer base, which is not, the term I use is pro-tail. I'm stealing that from someone, but that's I think the way they think of themselves. They're in there every day. They're not necessarily institutions, but this is what they do, and I don't like to call them day traders because
Is it like more of a prop?
it's more or less like a lot of small prop shops, basically. Like, you know, basically is a good way to think of a lot of our customer base. It does range from mom and pop to, you know, to large institutions and everything in between. but a lot of the activity is generated by these pro-tail type of customers, and you could see where their activity goes. You know, so they even within our numbers, you can differentiate where the investors go vis-a-vis where the traders go.
Yeah, it's funny you said that. That's how I always think about, you know, interactive brokers, is that pro-tail. But again, I'm interested to see if it feels like we are in a risk-on gambling sense. We were talking about, we just had the Super Bowl, or the big game. I don't know if we're allowed to say the big game. Parlays have turned into the new betting du jour. Everybody wants, because it's upsized returns, right? You're juicing the odds. You have a quicker ticket to riches on a smaller bet. Same like options, TQQQ, right? You're getting that leverage, and it feels like that risk on is there. And it's like, hey, not only are we going to bounce back, I think we're going to bounce back big. So it's looking for that really quick short-term horizon, and that feels like it's been dominating the market now. Again, going with what works, it's been working. Stick with it and double down on it, triple down on it, and it's continuing.
That could be spectacularly ugly, Rich, with some of those levered moves.
100%.
Yeah, for sure. And it's interesting because I think about sort of, I like that term pro-tail, by the way, but I do like the idea of like horizons and investor horizons, right? So like some of the levered ETFs, you may be looking to get a very short-term intraday horizon, right? When I used to trade prop in my previous shop, we used to use SPYs as a hedge, right? In my 401ks, I may hold something like VOO. So it's all a question of like horizons and what you're trying to do and the intentions and how you express that in the marketplace.
Yeah, I mean, that's a great point that he brings up, Steve, because you and I have discussed this before in terms of how UVXI was being used in trading portfolios, and that was like not a long-term hedge kind of trade. If you don't know what you're trading, to your point, Rich, it's could be spectacularly ugly, as I said.
The one thing that gets lost with levered ETFs is, I haven't looked at one in a while. There used to be big red letters on the prospectus, but of course nobody reads the prospectus, and I'm confessing that I haven't in some time. But they used to be in big red letters. These funds attempt to replicate 2x, 3x, the daily moves of whatever their benchmark is, but they don't. They acknowledge that they will lag, because anytime you have a fund that has leverage, it therefore needs to use derivatives to get that leverage. If you're using derivatives to get that leverage, you're doing one of two things. You're buying options, which decay, or you're buying futures, which need to be rolled. And generally, unless, with the rare exception of some futures that are perpetually in backwardation, like oil, you're swapping out. You're swapping out something that's lower than what you're buying. So they will trail. They do. This is a feature, not a bug. And I think that's why, while they can be very useful trading vehicles, I always get a little, agita when people tell me that they invest in these things.
Ultra short term. I had somebody years ago that would tell me they had a 3x levered position, like a core holding, and I was like, look, it's like that.
That's like a 30-minute play.
That's not what this is for. You can't just sit here and hold this, because you're going to decay, and it doesn't work. You're going to get run over. You're picking up pennies on a train, and they get hold. No. This is a core position, and then it was good night.
A lot of people. One of these came during the global financial crisis. When these things
SKF.
People got used to them, and I remember very intelligent people, several of them. I bought the minus 3x, SQQQs or whatever, and Nasdaq is down, NDX is down 20%, and I'm up like 30 or 25%. What went wrong? Well, they had to buy options at like a 50 vol, and so those options are decaying. They can't give you 3% over time because they own something that's evaporating. And so, again, this is not to dissuade trading accounts from doing this.
Trading.
But they're for trading. They're not for investing.
Yeah, Chris.
Funny you bring up the financial crisis. That's when I had my hedge fund, and we were actively trading the SKFs. And especially at that point, when you had the banks rolling over, you had Lehman over the weekend, you had Bank of America with Bear Stearns, Merrill Lynch, all of them. It was a great vehicle. And I remember one of my traders going, I think we're going to take this home. Like, you are absolutely not. You close out this position every 10 to 15 minutes, and you watch it just work, because it recalibrated at the time every minute. It wasn't a full trading vehicle, and the move in those stocks at that time was so exorbitant that you didn't know what was going to happen. It was a headline risk, kind of like what we're going to possibly experience coming up here, especially with tariffs. So that could be another headline risk again, trading in the moment, but maybe not for the long haul and investing.
But Christy, what's different now too is, I mean, the financial crisis, let's do the math here.
Yeah.
We're looking at, or nearly, well, two decades at this
yeah,
point?
But it's,
Yeah.
but it's still the same vehicles,
Right.
just with a different
Right,
wrapper.
but here's the whole thing: same vehicle, different wrapper, but the velocity of how news is consumed and how it is put out there really has changed market composure
Absolutely.
as well. There is no time to process
Absolutely.
these things.
Right. I mean, you're trading in milliseconds. Everything's out on Reddit as soon as it pops up or X.
Right.
And you have to be able to make it a decision. That's why the quant part
Which, by the
of
way,
it
could
is
be fake
very,
news. How
very
many times have
important.
we seen that where something trades off of
Fake
a
news.
fake tweet
Sure.
or
Yep.
a news outlet didn't verify it correctly, or now that you have people that have their own platforms via social media and other internet intermediaries, it's really hard to be able to discern that. I mean, it's quicker than half the filings can come out.
Well, the mantra I use in these situations is traders react, investors consider.
Right.
But right now, because we have so many active traders reacting, they're moving more quickly than the investors, which is just force. Neither is right nor wrong.
Right.
It's just force. Like to your
it
point,
changes
it's
the-
changing the way it's done.
Yeah, well, I mean, plus also the tools that retail investors, prop traders have now certainly
Zero-
weren't even available.
Zero
like, we
commissions
were on the
now.
desk,
That
but, I mean,
changed
even
the
tools
entire
that-
game with the number of people who are involved every day. Back, 2008, 9, 10, when I was trading, you were a commission trader. So how many trades are we going to make, and what's our alpha that we're going to try to capture here, and what's the cost of that? How many trades do we have to end up making? You don't have to worry about that now.
Yeah, but markets do evolve, and so much your trading styles
Yes.
and your theses and so forth. All right, guys, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.